So that's why it's very important for us to set up everything on YouTube, because already for some sessions, we have over 2,000 views during these few days. So it's really amazing. And let's start with our vision.
Forget the what?
Think about how it could be. A new mindset has arrived, where to share has become our greatest power.
It is this energy that guides us, will enlighten us, where meaning and purpose is a flame.
Burn inside every soul on the planet.
Welcome to the human-to-human model, uniting and inspiring leaders globally.
To build together with meaningfulness and joy.
Opening new possibilities for people.
Anticipating disruption. Rethinking society.
Who will reach their potential because the future is today.
Join us.
To be sustainable plus 100 world.
I think right now is clearly the way to act. Lack of clean energy will affect the Earth's core later.
I find that when people begin making small changes, they gradually get bigger because they get this feeling, I am doing something.
So we moved from greed-based civilization to human value-based civilization. Making money is a happiness. Making other people happy is a super happiness.
Wondering about your future? So bring your DNA to us today.
So this was about the vision. And first I'll show you this. Oh, maybe this one. So in our master plan, we noticed that, of course, it's great always to have a vision, yes, and dream. But in order to realize the dream, you need to have also the skills and financial capabilities. And as we noticed that we need to really rapidly scale up from billions to trillions, and we cannot make it without the financial community. Next film.
Solar Business Club leaders gathered in Dubai with the leaders of financial and investor communities, but also political decision makers to explore opportunities related to exponential growth of solar, battery storage, electric vehicles, hydrogen, smart energy, and other clean technologies.
Right now, you need to party. Make yourself rise up and walk away from things that's keeping you down. Yeah, you need to party till the sun rises up. Another day for you to change things around. Every day of sunshine.
During the next months, we will unite over 1,200 leaders on all continents to reinforce human-to-human relationship and work hand in hand on financial instruments and business models to scale up clean tech investments from billions to trillions while shaping the future today.
Every day is sunshine, sunshine, sunshine. Every day is every day is every day is.
And we will make it by combining business with meaningfulness and joy. Thumbs up for solar.
You deserve attention when you walk into the room.
So as you saw, we started with the vision, yes, because it's always to have a great vision for changing the world. But then we realized that in order to make the vision happen, we need to have financial and business models to make it happen. But I think that with the coronavirus, we also understood that we need to be united. And we cannot make it happen without being united between financial and clean tech leaders. And when we unite, I believe that we can scale up from billions to trillions more efficiently. Unfortunately, we cannot have an event like we made in Palazzo Versace, but let's start today with our online, and then let's work on the future plans. So now I would like to give the floor to Jean-Pascal. And I would like to really thank you, Jean-Pascal, that during just a few days, you were able to bring such amazing people to the panel. And I'm looking forward really for interesting discussion and the outcome.
Thank you very much, Tomas. And honestly, it's really a chance that we can actually gather all these wonderful persons, knowledgeable persons, probably the best I know in the industry, to discuss about this topic, and I would like to thank them for responding so with so much friendliness to my very late proposal. Again, my apologies for asking you so late, and I'm very, very, very happy and very proud to count you as my friends and working all together to make things happen. But before saying a few words about the topic of today, I would like to introduce Frank. Frank is a partner at Apricum and also the board member of DII. And Frank Beckers is going to moderate the session today. And Frank, if you want to say a few introductory words before to kick off the session, please, Frank.
Yes, thank you very much, Jean-Pascal, and again, good afternoon to everybody. For me, it's afternoon. I'm based in Dubai, so I'm 2 hours ahead of most of you, or 3, depending on where you are. As Jean-Pascal said, I'm going to moderate it. I'm very delighted. We have a great panel of experts here to discuss financial matters. I myself in project finance for about 27 years, mostly looking at emerging markets and running those businesses for some banks. And I think we all knew about the challenges. You can all see who is there. My idea was to just very quickly introduce all of you by just 1-2 words so that everybody knows who is there and who is who. So, I mean, you met Jean-Pascal already. Let me introduce him very, very quickly. He was going to be our chair. Jean-Pascal, as you may know, he's a real advocate and entrepreneur with a goal to make actually what we discuss as global goals, to make those concrete businesses. You may know he's the co-founder and CEO of Scale, which is a non-profit organization that participates in structuring and development of infrastructure projects, actually by proving the viability and then also making them replicable, which is very important. He's also the co-founder of the Terawatt Initiative, which is an international cross-sector organization that accelerates the transition into carbon-free economy, something which we're going to discuss today and how to finance it. We have on the call, and I already apologize for potentially not pronouncing some of your names correctly, so bear with me there. We have Kanika Shavala, who is Director for Center of Energy Finance at the Council of Energy, Environment and Water, which is one of South Asia's leading non-for-profit policy research institutions. We don't have her yet, we will have Elzbieta Klein with us in about 40 minutes. She's based in Washington. She's Director and Global Head of Climate Business at the International Finance Corporation, so one of the largest development banks in the world. We are missing Diogo Negrão. He seemed to not be able to make it. He was from CPDs, also a non-profit charity that runs a global disclosure system for investors. Actually, quite interesting.
So Diogo is from Brazil, so maybe still, yes, from São Paulo, and he's our chair of the club for the financial chapter in Latin America. So
okay,
might be a bit late.
We have Douglas Prentice, who is the CEO of GeoCapital, which is a UK impact investment fund that's investing into sustainable projects. We have Harry Boyd Carpenter, who's a director and head of energy EMEA at the European Bank for Reconstruction and Development, Europe's largest development bank. We have Rajiv Mahian, who is a manager and head of project finance at the Green Climate Fund, which is actually the world's largest dedicated fund helping developing countries to reduce their greenhouse emissions. And we have Harald Hirschhofer, who is a senior advisor at the Currency Actions Fund. which is a fund that is basically hedging, or by hedging currency risk, it aims to develop local capital markets, something very important and something that we may actually also want to talk about in more detail. I would now hand over to Jean-Pascal, who's going to actually introduce us into the topic in a bit more detail.
Thank you very much, Frank, and thank you for your kind words. The COVID crisis made very clear how fragile our societies were unprepared to handle a pandemic like the COVID and to avoid the very heavy social damages, both in developed and developing countries. It could be seen as a mini rehearsal of what the environmental crisis, in particular climate crisis, can do and may do, probably will do to our societies in the near future. Whatever the lessons we learn from this warning, one thing appears very clearly, bluntly even. The infrastructure on which our societies are built requires a serious upgrade. The investment to be made is gigantic, and the choice needs to be made between just improving the existing infrastructure, even if it has demonstrated once again its limits in terms of sustainability as in terms of universality, or we could decide to provide affordable and reliable sustainable infrastructure, services and commodities to all. All in all, the level of investment to be made is not very different. It's about 100 trillion US dollars by 2050, according to Brookings, and the difference between sustainable and not sustainable is not immense at all. We are in the same range. Considering the volume of this investment required to achieve affordable and reliable sustainable infrastructure, services and commodities, the chances are that these services and commodities will be provided to society through some form of public-private partnerships, where private sector would provide services and commodities to public or publicly backed off-takers under regulated long-term contracts, some form of PPPs. Chances are also that these partnerships would rely on off-balance sheet financing models, in particular project finance, since no companies or no countries, even the biggest, have the strong enough balance sheet and affordable cost of equity to carry on trillions of assets. Institutional investors, including pension funds, sovereign wealth funds, insurance companies, family offices, endowments, philanthropic investors, and foundations have expressed a growing appetite for sustainable investment in infrastructure, in particular climate investment, and they are handling 131 trillion US dollar in asset under management. Institutional investor would be able to massively bring the low-cost capital everyone needs for infrastructure. Yet, for the moment, a negligible portion of this money is channeled to infrastructure, in particular in emerging and developing countries, due to the following barriers. And they are very well known: regulatory and political risk, absence of experience of project developers and value chains locally, lack of bankable climate investment opportunities, underdeveloped local capital market in developing countries, high risk perception and limited availability of risk-adjusted returns for for climate investment in developing countries. The EDC's risk profile is particularly arising from non-project specific risks like country risk, currency risk, transfer risk, etc. is generally considered as incompatible with institutional investors' low risk appetite. It has been years that it is said over and over, conference after conference. But, and this is new, a massive shift in investment is now happening. Divestment of fossil fuel is starting under the pressure of the regulators, under the pressure of the markets and actors like CDP, for instance, and under the pressure of global youth. The drop in oil prices due to COVID-19 crisis will even accelerate this capital movement even more. This institutional capital will face a lack of assets to invest in. The potentially massive excess of liquidity may and will drive severe market imbalance and the overpricing of sustainable assets, in particular sustainable infrastructure, and generate potentially bubbles like we can see already in Europe. This imbalance is perfectly understandable since in a nascent sustainable economy, the stock of sustainable infrastructure is close to zero and the flow is just starting to grow. This is the pipeline issue that we hear almost every day about, which is now equally threatening EDCs because they are lacking of infrastructure services and commodities, and developing countries because they are lacking of opportunities of investment. Under one form and another, governments and the financial industry need to cooperate to transfer the current risk profile of the EDC sustainable infrastructure into something that can match the low risk, low return appetite of institutional investors. The existing de-risking instruments don't do the job. They were appropriate for large scale project by project context, but they are no longer appropriate for small scale design to cost of service and commodities context. They do not support upstream credit worthiness and are more focusing on the borrower credit worthiness. And they are not agile and scalable enough in the context of global transition. And moreover, they are not able to mobilize and catalyze at the same time the development finance and the climate finance. As the COVID-19 crisis demonstrates, that huge investments are needed very quickly to provide the people, the institutions, and the economy with sustainable infrastructure and services and commodities at scale, while taking away public resources. My provocative question to you would be, how, to paraphrase my friend Bertrand Badret, former CFO of the World Bank, can project finance can reinvent itself to save the world? Frank?
So, I think, yeah, okay, I see it now. So let me quickly follow up on this and then ask you one of the first questions. I mean, as Jean-Pascal pointed out, I mean, we are living in, unfortunately, I would say, pretty unprecedented times. We have a global crisis, which is truly global and which is affecting all regions at the same time. At least I have never seen something like this in my 27 years of career. It was either one or the other continent, but it was never that global. And I think as a result of this lockdown that we all see now globally, we have already seen that a large number of stimulus programs is being initiated all over the world to support businesses. That's becoming essential. And those will also, unfortunately, likely result in a certain shift in economic standing from many countries. You know, in other words, could lead to downgrading. So what does that mean? I think that's what we want to discuss, among other things. So will there be any regulations changed? Will the IMF have to ease up restrictions? Or are there other multilaterals? We have a few today with us. Are they already, or will they have to step up more? Do we potentially need more blended finance solutions, bundling concessional financing and development finance, and potentially also commercial finance? Is this now, and Jean-Pascal already touched on it, is this now a good, or is it the worst time to try to get more capital markets, institutional investors to step up? I mean, let's discuss all those. My first question to all of you would be, what is your outlook on how the markets are going to change because of this current COVID crisis? And I would say, let's go ladies first and start with Kanika, and then hopefully have a very lively discussion.
Thank you, Frank, and thank you, Jean-Pascal. I'm excited actually to be here and to hear the thoughts of everybody else. And unfortunately, I think that how can project finance reinvent itself to save the world is really, one of those blanket cover-all questions that I wish I had the answer to. But if we're any closer to finding the answer at the end of these 2 hours, I think we'd all be richer for it. That being said, I think the forecast is It's again hard to say. I think we actually, to me, the greatest uncertainty is not in terms of the value or the economic value that's lost, or like even thinking about the kinds of disruptions which we all have a good sense of now, but it's going to hinge very much on how much longer this is going to go on, and also how the kind of politics around it evolves. And the reason that's important, I think, is because it will determine where money is spent. Are we going to actually see a much greater nationalization of capital, whether that is public money or whether it is regulation and policy nudges on private and blended money as well, will actually determine how this development happens. And especially if I talk about from a developing and emerging country context, this becomes even more critical. If we're going to see capital staying more within the boundaries of where it originates, it's actually going to hurt the pace of the transition in many parts of the world. So that's one thing. The other thing, I think that there's already been a fair amount of discussion around, and there's the media is covering it as well a fair bit, is around the nature of the stimulus that we're likely to see, right? And of course, theoretically, this is also kind of an opportunity to think about how can we make the stimulus sustainable, and is it a way to sort of accelerate the direction in which the markets and the economy was moving anyway? So can we use some of this public money to kind of accelerate, I would say, sort of the decommissioning of thermal power plants or of other kinds of projects that were circling the drain anyway, and then rather take more strategic positions, maybe do equity, injections into strategic industries, things like that, using public money, things that we haven't seen so much of in the last many years. But it's also a time where, while all of that may make a lot of sense, we're going to see a lot of, the competing uses on public money are going to come very much in the forefront. It is really going to be driven by keeping people in jobs, making sure that economic value isn't completely wiped out. And that may actually mean that we may end up making the problem worse if you think about it from a sustainability lens, because we're going to keep propped up sectors and industries that should actually have maybe just not been bailed out, but kind of scale down in a phased manner anyway. So I think that a lot of my answers, like anybody who's trained in economics, is it depends and we'll see. But really, that's just where we are at, I think.
Okay, well, thank you very much. Who wants to go next? Well, Harry, what about you?
Yeah, thanks, Frank. I was just actually trying to reach for you probably saw I was trying to reach for the unmute button and learning the new etiquette of, of Zoom. And Zoom for me is a good example of, 2 months ago, I didn't even notice this existed. And now it's the most, it's one of my, most important tools. So I think, my first conclusion is that nobody knows, and that it's, any predictions are pretty challenging in this environment. Maybe I'll say just a couple of words about what EBRD is doing and responding. Many of your attendees may not know much about EBRD because we're a development bank that's regionally based. So we are operating in Central and Southeastern Europe, Central Asia, North Africa, Turkey, but not in Southeast Asia, not in Sub-Saharan Africa, and not in Latin America. So I run half of the energy business. I run the sort of the Western half of our energy business. And there are two main themes around what we're doing right now. One is immediate and one is long-term. The immediate thing is that we can see that many energy utilities are under huge strain. And that's fundamentally about a fall off in revenue. And there are a number of drivers for that. One is there's less demand, so people are consuming less energy. A second is that it's physically not easy to pay for it. In many countries, people need to get out of their houses in order to go to a post office or a bank or the electricity company's office in order to pay, and they're not able to do that. The third is that people can't afford to pay, even if they physically can pay, they have no money to pay. And the fourth is that, for reasons that are well understood, governments and economies are prioritizing food, medicine ahead of basic utilities, all of which makes perfect sense. But the outcome is that there are a whole number of utilities which are just facing a revenue cliff and running out of money. And that will have knock-on effects, because if they stop being able to provide the basic services, if the lights start to go out because they can't buy fuel or they can't do basic OPEX, then you have more problems. You're compounding a problem. Or if they stop paying, if they stop being able to pay suppliers, that has a ripple effect for economies. So we are working now with a whole number of utilities in our countries to try to provide effectively emergency liquidity. We have the capital stability, we have liquidity ourselves, and so we're looking to support them and essentially hold the our part of the economic fabric together. That's one big theme, and I have to say, I don't think my team has ever worked this hard. I mean, people are flat out on these sorts of projects. The second thing we're trying to do is keep the green momentum going, because I think we all felt towards the end of last year, beginning of this year, almost a sort of September New York summit was a sort of tipping point where you really felt that countries across the world were shifting towards a more sustainable model. And I think in my world, particularly of, Polish energy strategy came out. This is a country 80% dependent on coal. That came out with an energy strategy at the end of 2019 that talks about a wholesale transition to renewables. Greece is another country that, in September last year confirmed that it would exit coal by 2028, and most of coal will be closed by 2024. We all felt things were, the phrase I use is that stone was rolling down the hill and that things were really moving. And now COVID risks derailing all of that. And that's a really big worry. So on our side, we are very focused on supporting projects that keep going, that keep that momentum going. And we see a number of projects where, commercial banks are saying, for all sorts of reasons, we need to step back. We have liquidity concerns, or we have reduced risk appetite. We will step up. Where there are good projects, wind projects, solar projects, transmission investments, network investments, we will step up. And I'm hopeful today we will sign a wind farm in Poland, which fits that picture exactly. So those are the two big themes for us. Keeping the lights on, holding the economic fabric together on the one hand, but keeping the green momentum going on the other. In terms of, what do we see? I mean, as I say, I don't think anybody knows. I mean, any prediction is worthless in this current environment. What strikes me is how lots of things have changed very dramatically, and some things haven't changed at all. And if I think about the things that have not changed, climate change is still with us. Climate change is, maybe there'll be a fall in emissions this year. For sure, there'll be a fall in emissions. Maybe it will buy us 1 year, but the underlying problem has not gone away at all. And in fact, more vulnerable societies, more indebted societies will find it harder to deal with climate change, not easier. So that problem has got, if anything, has got bigger, not smaller. The second thing that hasn't changed is that renewable solutions are still the cheapest solution. Our analysis is that even with a collapse in an oil price, it's still, on any long run calculation, cheaper now in almost every country to rely on renewable energy. And the third thing is that interest rates were very low and they're only going to get lower. And that's good news if you're trying to invest for the long term. So those are the things that haven't changed. Of course, it's much more obvious what has changed, and a lot of things have changed. I'll pick one important thing. I think we feel much more vulnerable than we did. We are aware, and Jean-Pascal referred to this, we are aware of just how vulnerable our societies and our economic models are. And my hope is that awareness of vulnerability and that sense of the importance of, the sense of not taking for granted some of the fundamentals of our economic models will persist when things start to recover. And it will increase the urgency of moving. And I refer to climate change because it's so important in the energy debate, but it isn't just about climate change. It's about clean water, clean air. I mean, I'm sure all of us who are living in cities are appreciating at last what it means to have clean air. I hope that awareness will persist. And then to turn specifically to project finance, I mean, I actually think project finance was delivering quite well before the crisis. It will have an even bigger role to play. And after the crisis, because government balance sheets will be, everywhere very heavily loaded. There will be very little sovereign capacity, and we will be needing, to rely more and more on private financing models. To me, and I'll finish with this thought, what's crucial for project finance post the crisis is how projects are treated and suffer during this crisis. We have believed for the last 4 or 5 years that financing clean energy in its different forms is an extremely safe, stable investment, because you're providing a commodity that everybody wants without the pollution that nobody wants, and you're financing what is inherently a very stable long-term asset. And we have been able to drive the cost of capital down because of that assumption. If that proves not to be the case, if we find that during the crisis all of these projects unwind and there's a real problem, and that we start, and that these projects are not robust, that I think will be very challenging for the post-COVID world. If we can come out of this crisis showing that clean energy projects and clean projects generally were stable and survived the crisis, that will be a very powerful signal, and that will really help in the post-COVID world, because we will be able to say, look, all of this capital, if you want a safe home, it's this asset class which survived this biggest crisis. Put your money here, and put your money here at low cost. So that's why it's really important, I think, both for the short term, but also for the long term, that people like us and the regulators and off-takers recognize the stability and the long-term value of these assets and try to preserve them, because that will be enormously valuable in the recovery and in ensuring the availability of capital in the recovery. So those are my thoughts for now.
Well, thanks a lot, Harry. That was extremely interesting. Let me just summarize a few things, because both of you mentioned one thing which of course is very interesting and we all don't know is there are these huge stimulus packages, but we have to see where the money actually goes. That's one aspect. I just wanted to make one comment, and because I fully agree, the climate change is still there, and it hasn't changed. I found it very, very interesting to see the impact of us globally doing less pollution and everything for just a couple of weeks, and how much it already changes certain areas, and where fishes come back, where we see wildlife taking over just after 4 weeks. It's amazing. I mean, if we are able to reduce for months, then I don't want to even know what can happen. You mentioned one very important aspect with respect to two very important aspects that I want to repeat. One is that I think we all expect, with government budgets so heavily being loaded with the stimulus packages, we will hopefully see more private financing. So that should create an opportunity for PPP. And let's also discuss this going further. You mentioned that commercial banks are seeing some difficulties here and there. I can see this in my region as well. So I want to ask Rajiv now, is we see the development bank stepping up. What is Green Climate Fund doing? Are you reducing your activities? Are you increasing your activities, or are your activities not really being affected so far?
My apologies, I was on mute. So look, we are looking at this crisis as a major opportunity. Given the way things are presently, we are seeing quite a bit of reduction in fossil fuel prices, and that would create some kind of perverse incentives to keep running fossil fuel plants for a bit longer. However, what we are seeing emerge now is something that has the potential of transforming the market going forward, particularly new business models. There is a very, very clear impetus to keep corporates operational, corporates in the clean energy space operational, and that's an opportunity we would look at tapping. Clearly, what we are focusing on is also incentivizing some of the countries to direct their stimulus towards clean energy, use this opportunity to bite the bullet and switch off polluting generating plants, for instance. And that is something that will that we could potentially support. Early days right now, but yes, there are areas, for instance, if you look at large tracts of Africa, large tracts of Asia, where energy has not reached the bottom of the pyramid. That remains an opportunity for clean and sustainable energy to come in. Fossil fuels will not reach there, transmission lines will not reach there. Solar home system solutions could get there, distributed generation solutions could get there. That's the virgin market that remains quite attractive, and we would keep looking at that into the future. So while a lot may be changing negatively, today there would be a lack of incentive from sponsors and corporates to invest. We would see emergence of new business models, and that's something that would give us an exciting new opportunity to get into and invest and see those scale up those models across the world.
Great, thank you very much, Douglas. What's your view? How's your business impacted, and what is GeoCapital doing these days? Okay, do we have Douglas still there?
Yes, but I think he's muted.
Can you hear me now?
Now we can hear you, yes.
Sorry, I did unmute it, but it did a pop-up asking me to unmute again. Yeah, I was just listening to what everyone was saying with a lot of interest. We are quite active in, and have been for some time, in exploring alternative financing mechanisms, project finance mechanisms to supplement the usual methodologies. So particularly aligning those mechanisms to the financing processes of the Paris Agreement, Article 6 of the Paris Agreement, of which 3 of the 4 we utilize: cooperative agreement, cooperative approaches, sustainable development mechanism, and ITMOs, international transfer of mitigation outcomes. So on cooperative approaches, GeoCapital runs an FCA regulated energy and environmental cooperative in London. And with that, we aim to engage with Indigenous peoples to ensure that they receive a financial benefit in projects. One of the great drawbacks of PPP, PFI in the past has done a lot in the UK is that big companies do the projects, but the local people don't benefit from them. So the Sustainable Development Mechanism, the Paris Agreement, is quite important. I'll give you an example of what we're trying to do on that in a moment. And the third one is international transfer and mitigation outcomes. So we have developed a DLT platform for offset carbon trading and a mechanism for carbon monetization in territories where the government doesn't grab the abatement and account it against its own NDC, because then we can't monetize it. So in certain territories, we have found it is possible to do it under local law. So for example, we've been working in solar for a long time in Europe, in Andalusia and Spain, under the auto consumption law and large, smaller scale building mounted PV, larger scale ground mounted cell to grid under a PPA. We're working in Alberta on a methane capture and electricity generation program. And that one was the one I said I would give you the example of, where effectively methane has a GWP 28 times CO2. So it's probably the second, maybe the most dangerous greenhouse gas in terms of its warming potential. It's also fairly prevalent today, coming mainly from animals, wetland cultivation, and escape from gas pipelines. So in Alberta, it's Alberta is the gas hub of North America. It is to North America what Houston and what Texas is to oil. So a lot of methane is lost in about 400,000 kilometers of gas pipelines in Alberta, and we are working with an EPC over there to capture that, either re-inject it into the grid or burn it to create electricity. And working, we hope, with Indigenous peoples, which are in Alberta, the Blackfoot Confederation of the Sioux people. So essentially, our approach to the question of project finance is to try and add into co-finance, traditional debt equity, infrastructure type project financing, three things. One is DLT platform management, two is carbon monetization, where we've developed an algorithm for pricing carbon going forward with a leading university, and three is to involve community groups through local cooperatives. So that's basically what we're doing.
Great. Well, thank you very much. Douglas, it wasn't always easy to understand you, so it's
sorry.
The microphone. So we haven't heard yet from Howard. So Howard, we'll be very interested to see to hear your views and what the currency exchange fund is actually doing these days, and what your role or what you see could be your role post crisis.
Yeah, Frank, thank you very much. I hope you hear me well. My microphone I had a problem this morning. I hope it's fixed.
No, we hear you well.
Okay, very good. Excuse me. I would like to talk about three topics. First of all, as you just suggested, talk a little bit about TCX, what we are doing. I will talk about how we will, and we are already working together with renewable energy developers and operators. And then I will end by reflecting a little bit where we are with COVID, how it has impacted us, and what we are doing to be prepared to service the flows which we see coming towards us. So TCX is a multilateral development initiative. We were set up by about 20 to 25 development banks, and we have support from the Dutch, the German, the UK, and the Swiss governments. We are currently discussing also with the Canadian government and the French government to join this effort. And the effort is really, and perhaps I go a little bit back to what Jean-Pascal said at the beginning, you know, how do you change project financing? Our aim is a little bit to improve how development finance works broadly, but perhaps even more broadly, cross-border financing. If you look at, our mandate is to improve cross-border financing when typically from richer countries, funds are flowing to finance projects and finance expenditures in the poorer countries who do not have enough savings to build the infrastructure which is needed. So our role is to take the currency risk, which is typically related to hard currency borrowing, away from the shoulders of the borrowers, because the borrower is typically not even aware of all the risks they are taking, and they don't have the diversification abilities to manage that risk well. So the role of TCX is to create a global risk pool, become a global market maker by capitalizing on two main capacities. The first one is scale, which allows us also to diversify optimally. And I will get to that when I talk about COVID. And the second capacity is our understanding of currency risks or macroeconomic risks, which we derive from deeper analysis than most market participants, other market participants are able to do in these frontier markets and emerging markets. And because of that, we have now about a portfolio of 4.5 billion in exotic currency risks. We are active in 90 developing countries. So we are covering almost every country you can imagine, with the exception of a few in conflict or just post-conflict societies. And we have also, very important for your audience today, no tenor limits. That means we can offer in Ghana 15-year, 20 years. That is, we would say, our standard for us right now. In India, we could go up to 30 years and offering that. So So how are we working together with renewable energy developers or financiers? Let's assume you have a project in Ghana again. You have a PPA in the local currency, which is the cedi, and you finance yourself in, and now you need to make the decision, how do I want to finance this project? Do I want to finance it in cedi? That is possible. You would approach one of our development finance partners, our shareholders, to give you a loan in cedi. It's typically a synthetic loan. Or you would be able to hedge through a commercial bank directly an existing hard currency loan, so that you have the mismatch between the cedi revenues and the hard currency loan. And that also we could work with the commercial bank to take that risk off your balance sheet. How do we do with COVID? And that is, of course, was very. We started to see this already. We prepared in January for that, and the first effort was that we said everybody has to work from home. So we did an exercise of a day in January, and it worked quite well. So I can say we went into the crisis very well prepared, and by the end of February, we decided to all start working decentrally. At that time, we had a capital ratio of 26%, which is very high. We are following sort of Basel standards. And today I'm very happy to report that we still have a capital ratio of 25%. So we had significant losses, but our global diversification model helped quite a bit that we could withstand these first impacts. But I have to tell you, and that is probably, of course, the bad news for many of you here listening to this, is the price of currency risk has increased. So we see, of course, the interest rates in the hard currency, in the funding currencies are going down. But at the same time, because of COVID and the uncertain impacts it will have on the real economies in our target markets, we have seen the prices in these currencies going up quite a bit. So how are we reacting to that? We have been, of course, approached by our shareholders and by our partners, including governments, to think about ways of how we can increase our capacity of hedging, because we see quite significant potential demand coming towards us, from refinancing, that many of our shareholders have been approached by their clients. This is not only renewable energy, but all across the board, to renegotiate the loans, particularly the payment horizons, extend the payment horizons, and have periods of non-payments for the next year or so. That requires from us to reprice our swaps, our hedging instruments, and that absorbs capital. It will also make it more challenging to price. And so we are looking at new ways of sharing risks in the pricing. We are working with the European Commission on a specific initiative of that, which would allow us to price a little bit more aggressively. The second source of additional flows, we see that there are new funds being set up in a number of areas, not only in renewable energy, but also one in renewable energy area, to help as sort of an emergency the industry. And we expect that flows are coming from that too. This will be mainly short-term flows, so it will be relatively easier to hedge for us. But unfortunately, pricing is still a challenge. So as to sum up, COVID is a challenge for us to price, because volatility in markets is going up. Risks are becoming more unpredictable and less quantifiable. But we are relatively in good shape, and we are very happy to deliver significant amounts in the next 2 years to your sector, but also to other sectors.
Well, Herbert, thank you very much. That was very interesting, and I think, well, the currency hedging aspect is of importance if we want to strengthen the local markets, right? And fully agree. I mean, we see too much hard currency lending, and well, supporting local currency and local capital markets will help a lot. So the cost has gone up. Doesn't really come as a surprise, but I think it's something we will have to deal with. Let me welcome Alzbeta and also Diogo, which both are there now, to the call. I would say, ladies first again. Alzbeta, a question to you. But let me first summarize to the two of you. I mean, obviously, we didn't reach any real conclusion yet, and no surprise. If at all, then there is one conclusion that we all cannot really predict what's going to happen. It's very difficult to forecast. We're all expecting public budgets to come under more pressure, given all the stimulus packages. So we see an increasing role for private financing, obviously. Harry from EBRD has pointed out that they are stepping up to support the energy industry, and which is important. So my question, Alzbeta, to you at IFC, I mean, you're active globally. How do you see your role changing because of the COVID-19 crisis, and what are you planning to do or already doing to basically help organizations and help particular clean tech projects?
Thank you. Hi, everyone. I hope you can hear me. I hope you can see me. Delighted to be part of it. And Jean-Pascal, thank you for the invite to this conversation. So look, let us start with the basics. And the basics in my mind are that we had about $100 billion outflow of capital from emerging markets in the past 6 weeks. And it doesn't look like it's going to stop. So basically, you've got every possible liquid fund departing emerging markets today. So I was listening a bit from our friends about local currency. And yeah, this is going to be a critical issue. So what is it that multilateral financial institutions can do? And what is it that we can all do to do two things? First, reverse that flow of funding to emerging markets, to anything, and then reverse that flow to emerging markets doing some longer term financing. Because today, it's a question of reversing every single capital flow, not just financing long dated assets in local currency or in dollars. So in turn, liquidity has completely dried up. We see it in numbers. We see it in a number of our clients who get in touch and look for any kind of financing that they can have. And therefore, we have set up the first $8 billion facility, which is basically a liquidity and trade and working capital facility, because you can't really think about longer term clean tech infrastructure investments unless you have some basic capital flows going to the markets. So we're starting with the banks because they are critical to restart any kind of lending, trade finance to start with, so that goods and services can flow. In clean tech space, you have seen severe curtailment in many countries of the offtakes, especially the one where I happen to live, the United States. But we also see developers who are not getting their equipment because there is no trade. So you can't even think about infrastructure. You can't even think about longer dated assets until you restart that capital flow. And to restart a capital flow, you need to get some trade finance going. So that is the first order of the day. We announced our $8 billion program a couple of weeks ago, and it looks like it's going to be hugely oversubscribed. So that's stage one. The second stage is to start thinking about working capital. And this is for clients who are fundamentally solvent, but they lack liquidity. And again, we are seeing it in some of the infrastructure clients for obvious reasons, because anybody who is in transport has stopped, any airports, any airlines, shipping to a degree. So working capital is the next order of the day. And when that is put in place, then we can start considering what we are going to do for infrastructure. And I'm just going to say a couple of words on this and pass it back to you. So in terms of infrastructure, We have been working under the One Planet Lab for quite a while, for about 16 months now, with HSBC and Climate Policy Initiative and CPI on sustainable infrastructure. And I think when it comes to COVID, and especially post-COVID, we have an opportunity to build differently. So we are working on something that we call provisionally green rebuild. But basically, we feel that if you are going to put funding into emerging market infrastructure, we should think about it upfront as something that will become an asset class and that will become investable by private investors from developed markets. Why is it even more relevant today than it was 16 months ago when we got started on it? If you look at the size of fiscal packages that we are all getting in countries where some of us live, Western Europe, North America, those fiscal packages are roughly 10 to 12% of GDP. When you look at fiscal packages in emerging markets, they are about 2 to 3% of GDP, with the exception of South Africa yesterday that put out 10% of GDP. What this tells you is that public purse will be empty. There'll be very little left that can go to fund anything. So when we are thinking about long-term sustainable infrastructure assets, we have to bring private sector even more than was the case a year ago, 16 months ago when we started working on it. So for that, we have to think about it as an asset class. We have to structure it a priori financially so that it can be an asset class, so that it can attract financing, whether it's de-risking, whether it's having GCF, my friend Rajiv, hi, we'll probably talk about it, whether it's de-risking from somebody else. The goal is to bring in most of the private funding that we can because there's nobody else who will be able to finance it. I'm gonna stop here, back to you.
You're muted, Frank.
Thanks, JP. Didn't realize that. Thank you very much. I think you made a very, very important point, Alberta, which is the fact that we see increasing risks now with all these fiscal packages and with the credit risk of a lot of emerging markets most likely going south. And de-risking, you mentioned it, is going to be a very important issue. And I want to talk about this in a second, in particular about what that means. How can we get more liquidity into this market, private sector? How can we get institutional investors into these risks? How can we de-risk there? Which role can you play as development banks, etc.? But before we go there, Diogo also made it to joined us. So welcome, Diogo. And I just wanted to give you also a chance and hear about what a CDP is doing and how you see the impact of COVID-19 on the market for the future.
Yeah, thanks, Frank. Good morning, everybody. Jean-Pascal, Alberta, Rajiv. I probably know some of you from LinkedIn already. So we are all connected somehow in this moment that we are living. And apparently this is the way to go now. I don't think there is much alternatives for us, at least at this point. And for sure, we're gonna see some changes on the way to do business from now on. So thank you very much for Thomas for the opportunity to be here and to be speaking in this panel.
Thank you, Diogo, for accepting to be chair of the financial chapter in Latin America. Thank you so much.
Thank you, Thomas. Greetings. So let me just make a quick introduction about CDP and my role specifically down here in Brazil and in Latin America. So CDP is it's a non-for-profit organization that has as mission to promote transparency from companies and markets regarding climate change, and so that corporate investors may have the better information on the companies, on their investees and their portfolios of investments. So CDP came out on the year 2000, and this is a funny story. From a group of investors, a small group of investors from London, and they wanted to understand how their investment portfolio were dealing with climate change. So they made a quick questionnaire on Excel, and they sent this questionnaire to their portfolio of investment with questions on on climate change. And they had about 50% of responses from their portfolio, and 60% of the companies that responded the questions said that their business had no impact on climate change, and that climate change did not impact their business at all. And one of these companies were British Petroleum. So this is very illustrative for us on the change of awareness regarding climate change and sustainability from 2000, the year 2000, from today. So today we have more than 8,000 companies responding to our questionnaires. We have 3 questionnaires. One is regarding climate change specifically, and the second one is water security, and the third one is from forests and biodiversity. And we understand that water and forests are strictly related to climate change, so we focus on climate change as our main concern. On this matter, we have over 500 investors as signatories of CDP, and these investors, they have $106 trillion in asset under management. So this is 1/3 of the capital market, the global capital market today. So it is very representative on financial markets, and serves as a way to illustrate the importance of our work today. And well, the way I'm going to approach finance on this conversation that we are having here today is a little bit different from what Asbeta was explaining during her speech. I apologize, I was late. It's 8 a.m. here in Rio de Janeiro right now. And so I couldn't see what was the discussion prior to that. So today, the way we are looking at this question, as we are working to promote green finance agenda. So we are often speaking to asset managers, to pension funds, banks, insurance companies, development banks, regarding how they could boost green finance in Brazil or in Latin America region. And so the way we do this is by offering tools and background information so that these investors can have the right information when they are assessing projects or companies they are willing to invest. So one thing that we are doing today is we are calling this portfolio assessment. So what we do is to go through a portfolio or an investment fund and try to understand what are the impacts from that portfolio or from that fund specifically. So we have carbon footprints, we have impacts on water, impacts on forests. We have also one specific tool is called Climetrics, which is something that investors are using to pick funds so they can have an easier, a more friendly way to identify environmentally friendly funds regarding climate change and regarding funds that has lower environmental impact, so they can invest if that's the way, if that's what they're looking for. So, and we are also working on this matter regarding urban infrastructure, green infrastructure. So we also work with cities and states, and we have today we currently have a pipeline of projects that demand investment in Latin America of about $5 billion of projects on green infrastructure, urban green infrastructure that requires investments. So this is also part of our work to bring these projects to light so that investors can address these projects if this is part of their investment strategy. And plenty of these projects are related to clean tech and renewables. So Frank, I'll leave this here with you, and hopefully I can speak a little bit more later.
Diogo, may I ask you a question, if you allow me, Frank?
Sure.
Can the tools that you are describing be used for the stimulus packages and to direct the stimulus packages towards climate and sustainable investment rather than, I would say, business as usual?
Yeah, hi, John. Yeah, sure. We also have, so this is the interesting part of the discussion, I think, because with this situation we are living in due to coronavirus, yes, it's boring. Nobody likes to be sitting at home like this, but at the same time, there are opportunities. So what we see today, there are plenty of, you know, the General Secretary from United Nations just mentioned that we have a huge opportunity in front of us to regarding the rebuild of our economy to be that it should be green. So you know, there are a lot of stuff going on, like the price of the oil barrel, you know. So we have this. So our work is based on a few packages, not really packages, a few boxes. So we deal with corporates, we deal with the financial sector, but we also have an advocacy team that works very close to governments and to policymakers in order to raise the awareness regarding climate change, low carbon economy, sustainability, and for sure, this is something that we are here in Brazil. We are working very close to this senator that is working on a carbon market to install a carbon market in Brazil, a policy to install carbon market in Brazil. And so yeah, this is something that we address quite often, and is part of our mainstream work.
Thanks a lot, Diogo. And just wanted to come back to the de-risking, because what Beta said before is concerning me a bit, to be honest, and that is the huge outflow that we see from emerging markets. And obviously, we've always waited for more institutional investors to go into the market, which was to some extent not happening because of risk. So let's talk about what can be done to change this. I mean, how can we help, and how can institutions like IFC, EBRD potentially, how can they help, or others help de-risking not only projects but maybe also country risk? And is the risk profile predominantly going to change because the country risk is going to change, or is it potentially also changing, and I'll leave this up for discussion, or is it potentially also changing because governments are going to put less and less efforts because they have less and less money in properly preparing those projects, and we get poorer and poorer structured projects actually that are hitting the market for financing? So really interested in your views. I think Kanika you wanted to say something?
Yeah. Thank you, Frank. This is something that, I feel very strongly about. A lot of the work that we do at the CEW Center for Energy Finance is around understanding risks. And we try and think about them in we try and split them into perceived risk and real risk. And we think that this is extremely important, especially in the context of developing and emerging economies, where the risk perception often tends to be much higher than real risk on the ground. And this is because of a lack of familiarity with those markets, because of lack of data. And usually the transaction cost doesn't necessarily justify detailed due diligence. And so we continue to be trapped in this sort of a high risk kind of perception, which may or may not be true, right? So, and it doesn't necessarily reflect and move with what's happening in real time. I feel like for a lot of emerging economies around the world, but especially for India, for clean energy, we had overcome that to a large extent, especially for utility scale projects, where there was enough signaling and enough evidence of how well these projects were performing. Also, compared to other power sector exposures, how renewables was much less risky. There wasn't really supply chain disruptions. There weren't cost overruns. There weren't time sort of overruns. And so it was, things were looking good. And suddenly, because the kinds of risks have changed, that we're going to have to go, we're basically going to get sort of stuck back in this lack of familiarity with the market for projects across the board, whether small or big. And of course, every single risk is exacerbated for smaller underserved markets. But even for large utility scale projects. So I wanted to spend a little bit of time talking about sort of how these risks, what are the new risks? And I think that we've identified them as we've all gone along, but I'd like to sort of put it all into one conversation, then also talk about specifically from a developing country perspective. So I think when Harry was talking about keeping the lights on and making sure that utilities stay viable and in business, what that also means is that they're really not going. So there's already in developing countries a very large counterparty risk or offtake risk, as we call it, and this risk is going to get extreme, like it's going to grow by a lot. The delays in payments that we were already seeing, these are going to sort of maybe even double. So that's one thing. And then that also then obviously leads to further working capital issues because of lack of cash flow for these IPPs, right? So one is to try and understand that. The other is disruptions in the supply chain, which is really interesting because that's a kind of risk that clean energy hadn't really seen for, I mean, yes, there were some studies around does it really do enough on energy security, because there's this very large dependence, like for a country like India, 80% of our imports of cells and modules are from China. And between the lockdown first in China and the lockdown now in India, it's hurting as much as 52 gigawatts of the solar of tendered capacity that's not yet operational, right? So it's in different phases. And this is not, I mean, we've seen a lot of this kind of, coal supply chain risk for thermal, but we haven't seen this before. And is this a completely new variety, or is this something that we're just going to sail over once, the lockdowns end? It's hard to know, and it's really going to be hard to see how investors sort of perceive this kind of risk, which they've not dealt with in the past, right? But also, I think that the risk that is, to me, to my mind, unique to developing countries, but also going to be critical in the way investors think about clean energy projects is going to be demand risk. We've a lot of the kind of energy transition in emerging economies is precipitated on the fact that there's growing demand, and you don't have to pick between fuels, and you can follow kind of an all of the above approach and be almost fuel agnostic and pick the cheapest source at the margin, right? And that's why renewables has been winning. But when there is lower and lower demand, does that mean that countries are going to revise their ambition downward because they just don't? So it's still, in terms of share, maybe going to be the same as before, but in terms of actual installed capacity, going to be a smaller amount of renewable energy capacity. Or is this going to be an opportunity, like I was saying at the start, to really radically change the electricity system, where you actually say it is still the cheapest to install new clean energy capacity and retire old fossil fuel capacity? But to do all of that, there is a need, of course, for money, but there's also a need for policy and political bandwidth. And that's what we don't have right now. For someone to make this decision, they need to actually take the time to weigh the costs and benefits, to see sort of the socioeconomic benefits and costs that will be, and sort of really measure the trade-offs. But when you're thinking about, the largest kind of migratory worker movement that India has seen since its partition, there's not really that much, political bandwidth to be spent on thinking about what our energy transition pathway is looking like right now. And I think that it's important to identify that while in principle this may be an opportunity, how do you actually make sure that it stays sort of high enough on the priority order for it to get addressed? And then the last point that I'd like to make is around project finance itself. And while I agree that the project finance market is going to become increasingly important, and a lot of it is going to use public money to underwrite the kind of, and to create the kind of facilitative environment for more private capital to come in, this is also not kind of new. This is also what we've been aiming to do forever now. Of course, its importance increases, but I think that the sense of urgency was already quite great, I would say, 2 months ago or 4 months ago. But that being said, I think that, again, in emerging markets, the problem is further exacerbated. And this is because what are the sources of project finance? For a lot of these countries, there isn't a well-developed bond market. The bond market also does not reward a green rating, right? So you will continue to then have an over-reliance on bank debt. And while renewables may be best in class, and within the power sector portfolio trumps everything else, it's still a very small share of the total amount of capital that is required. And this is, I think, again, where Harold's point around currency risk, which we do actually know how to deal with, and there are facilities available, but again, if the pricing is prohibitive, etc., it will be important, because countries will need to borrow from geographies beyond their own. And this, again, I think is, of course, entirely market principles and how do you make business models and financial models viable, structuring of capital, etc. But it's also going to be a policy and political issue, where how do we sort of avoid capital from this deglobalization kind of trend that we're seeing around the world, right? And actually, that's why for an institution like us, which is a policy and research institution, these are really important questions, because they're not limited to just the finance box or just public or private money. They're really kind of much more. They have threads that run from across different things. So I think that while I've only posed more questions around this de-risking, I think it's important to try and think about them in this interconnected way.
Thanks a lot. I mean, you made a very important point. I mean, I live in the Middle East now for 13 years, and I think for 13 years on conferences, I've been talking about the need for institutional investors to come to the table, and that we have too much dependency on bank financing. Still, it hasn't really happened, although some of these countries here have a AA sovereign rating. So it's so why is this happening? And let me I mean, I discussed it with Jean-Pascal a few days ago, and I said, I'm missing the good old days when we had monoline insurers and we had so many institutional investors coming into the infrastructure PPP market. And so the question is, we don't have them any longer, but can not certain institutions that are able to take certain sovereign risk kind of come up with a similar model in terms of, because if I look at Althbeta and Harry being representatives here of very large development banks, also your liquidity will come to an end at a certain stage. So liquidity is there in the market with institutional investors, but how can we help on the risk side to bring that liquidity into risks that are particularly country risks that they're currently shying away from?
Well, can I perhaps comment on this, Frank? As Harold. Because also Kanika said before, in India, it's a little bit different because they have a deep capital market and domestic market. And I hope this stay, that is certainly the case. And in many other countries, this is not the situation. And going in the next few years, you probably have a massive crowding out too of through the government. But to comment on your question, we talked to one very large institutional investor recently who bought a number of renewable projects in India, and we talked about hedging the Indian rupee long-term risks. And the fact was, so everybody around this table was very good-willed, and we wanted to make this happening. But you will quickly see if the numbers often don't add up. The expectation, the return expectations of institutional investors for de-risk capital are sometimes still very high. So the de-risking is not very well paid for, or when you charge market prices, it just doesn't work out. Allow me perhaps, may I just come to another topic, which I think is quite relevant, or would you rather continue on this, Frank?
Well, I think Althbeta wanted to basically respond to what
I'll come later. Okay, I take it later then.
Actually, Frank, I have a question for Harold in the spirit of a good conversation. So, look, you were asking how we can de-risk, and I'm sure my friend from EBRD and others can tell us, and we can compare notes. But there's one particular thing that's showing up right now, and that's swap costs, right? So local currency is a big issue. And the question is, how do we buy down swap costs? And I think it's more a question to Harold for his thoughts on that, because we know that it's not economical today. And unless we get some first loss donor type instrument, it's going to be very hard. But I was wondering if Harold has any thoughts on that, because this is how we can possibly work together.
Well, I mentioned before that we are currently trying, and that's not the first time we're trying this. We have done it in Myanmar with a project called LIFT, where we make essentially local currency financing more accessible in the area of microfinance. And I know that IFC was also interested, and I think you participated in that program too. It is very difficult because in order to meaningfully reduce local currency interest rates with this current uncertainty, the inflation expectations are running all everywhere. it is very difficult to come up with the required donor resources to make that happening. I think still the best is in the long run to make sure that macroeconomic policies, particularly monetary policy, are transparent, forward-looking, to bring down the risk perception and the risks. We are trying a new innovative pilot with the Commission right now. It's not approved yet, but I can outline roughly how it should work. It is, in some of these markets we have very low data. We don't really know what we are measuring from the macro risk side. Plus, you have very high volatility in recent weeks. You have seen this, and why it's all across. So forming a price, forming an assessment of the risk is very difficult. And if you, as a prudent manager, have to price in such an environment, the risk premium you're charging has to increase, right? So what we are thinking is to work with donors to guarantee our shareholders a certain performance of a portfolio, and in return we are pricing more aggressively that portfolio. I do not call this a subsidy. It is not a subsidy. It is reducing the risk premium by sharing these uncertainties a little bit broader, right? How much will this bring? 100 basis points, 200 basis points. In some countries, it will make a difference for sure. In some industries, it will make a difference with tenors. But will this immediately bring these billions into the frontier markets which are needed? That element alone is not. We need to have other solutions there as well. But we are certainly trying and to learn and to price more correctly.
Great. I think Harry, yes.
Yeah, maybe firstly just to pick up on the theme of the local currency issue. I mean, I think what again this crisis will expose is what happened in 2008, 2009 is how vulnerable you are when you borrow in a foreign currency without effective hedging tools. And we've been talking about this for years, and the difficult conclusion I keep coming back to is that there isn't an easy answer. What Harold and the TCX can do is great, but it doesn't. You've got to really address it by changing the fundamental systemic problem, which is the absence of deep local liquid capital markets. And all of us have programs trying to do that, but it's not something you can solve in one sector. It's an economy-wide problem, and I think we saw this problem after the great financial crisis, and we'll see it again. I hope that'll just make us work twice as hard on it. If I go back to your question about what will change, where will the risks come? I think the supply chain risk is the one that worries me the least. We see it coming, but we see it in an order of weeks, maybe months. It just shows you the power of a market. I mean, I hear of stories every day of people finding new ways around the problems. We have a wind farm now that we're financing that's being commissioned remotely, where the commissioning engineers can't get to the site, they can't get to the country. But the people who are on the ground are literally walking around in the cell with a webcam, showing what they're doing and being told, push this button, okay, this is sending the right signal. The market finds a way. And probably no one will ever do it the old way again. People will start commissioning from their sort of, apartments in Copenhagen. So that worries, that's a problem, but it's not a big problem, and it's not a systemic problem. I think the big worry I have is really, being very frank, it's political appetite. Will a political appetite to pay the cost of a green transition survive a crisis which feels much more urgent and immediate? And I can tell you, there are at least 3 countries in my universe who are clearly either threatening or actually going back on their offtake agreements for renewable energy. And that's reality, unfortunately. And they're doing it not because they don't want to honor contracts, and they're doing it not because they've changed their mind about climate change, but they're just saying, this is an existential problem we have, and we can't pay. And that is understandable, but it's also a huge threat. And that's why I think I go back to what I said in the original, in my original intervention, which is the best thing we can do for the post-COVID investment world is get the current investment environment right. If we can find ways, working with off-takers, working with governments to navigate this period and show that clean investment survived this crisis, that will be an enormously powerful signal. And that it's not about, I think, big structural changes post-COVID. It's not about, new models after COVID. It's about showing that the fundamentals we believed in and that we presented over the last few years were true, and that these projects are robust. If we do that, I think institutional capital will really get the message, and we'll be right there when things stabilize.
Frank, may I jump in here, because I would like really to comment what Harry just said, and that's actually what I wanted to mention before Alsbeta asked her interesting question. Let me be provocative here. I believe in the future there will be many fewer dollar-based PPAs than today, because we see again, COVID makes very clear, if the population is hit, the idea that regulators can just unilaterally mandate an increase in tariffs doesn't work. I've seen it in a number of cases in Zambia, where it's in Kenya, when you have very strong shocks, which are completely outside the country, right? Like COVID is. You cannot just increase tariffs by 20% to compensate the utilities for the losses from the exchange rate. And I think in the future we will have, and we should have done this already many years ago, much more PPAs in local currency. That means that the costs of the energy units perhaps are a little bit higher at the beginning, but you will have a much more stable credit quality of the utility. You have a much more sustainable situation for the customers of the utilities. And at the end, we will find, and TCX is now at 4.5 billion. We are aiming towards 2 billion of capital. Just to show you, if the market is challenged, there will be solutions found. We will find solutions to increase the volumes of cross-border financing indexed to local currency.
Thank you. I mean, that's very interesting, because that would kind of change the flow, because currently we have international money flowing into these countries in hard currency to finance. We obviously, in a lot of these markets, don't have enough local liquidity to finance all these projects. So we would then have international money flowing and being swapped into local currency. At the same time, then we would have to develop the local markets. I mean, I fully agree. It will most likely require local governments also to understand that at the end, it may be the cheaper solution, because they only look at, most likely currently, at what the interest rate is that they can get, which is much lower on the dollar-based financing, but they don't really price in the exchange rate risk that they're taking. And they're taking it sometimes in their PPAs up to 30 years, which is, at least if I look at my region, where we have very long-term PPAs which are indexed, which is quite a currency risk. And I wonder how it's being actually priced into, or how the risk is being priced into the off-taker's budget. Most likely it's not really priced into it, right? It's but it's there, and that will become much more and more obvious for people. So that was, so we've touched one aspect, which is the de-risking, and which is the currency aspect. Can we help? Which is of course one very big aspect of country risk. But I will want to come back again to the institutional investors that we need to come to the table, and those also require, well, a lot of them require ratings. A lot of them require tradable investments, and there, how can we find instruments there to really tap these very deep pockets of liquidity? Because obviously, if you go and rate the projects now in most emerging markets, you're going to be in deep sub-investment grade territory, and that's not going to attract many institutional investors. How can we bring this up? And I know my idea may be a bit provocative, but I come back to my my monoliner idea. I mean, they brought this rating up, and that's what actually brought all these institutional investors to the table, and they all came, and we had this huge inflow. We had it by way of bonds, which we can talk about. But what can we do there?
Frank, if I may, I mean, I'll disagree with you a bit there, because I think you're right. I mean, the monolines were great, but you know, the monolines solved the problem by saying, okay, you want a rating, here's the rating, and they put their own. They were willing to take the credit risk. You know, what I would rather see is institutional capital expand its appetite.
We're losing you, Harry. At least I cannot hear you. I'm not sure whether the rest can hear you.
Harry, we can't hear you.
We can't hear you. You suddenly, we can see you, but you were suddenly, your voice was suddenly gone. It became a bit metallic, and then it was gone.
Very strange, because Harry is not unmuted. It's not muted.
No. Maybe he has to reconnect, or.
It's just because he was disagreeing with you, Frank.
But actually, while he's gone, can I just pick up on his point? Because I like that point. I just think that it's a bit utopian to think. So I agree that institutional capital should expand its appetite, and also that we need to kind of scratch the surface a little bit on these ratings themselves. So I'm going to use an example I understand well, which is from India. So renewable energy projects are capped by the power sector rating. But that is, in my mind, a fundamentally incorrect way of doing it. Because there's just, the risks are different. You don't have the same kind of, I mean, of course, you have the same counterparty, etc. But even the leverage you have with your counterparty, the relationship is completely different. The language of the power purchase agreements is different, right? So renewables are the only fuel class that has a must-run clause, and you don't just put it into the merit order. So the curtailment risk is lower, at least in principle, it should be lower. And so they should. So actually, what I think that one of the ways to think about how institutional capital can be made more friendly is actually we stop being so shackled by the way that we are doing our credit ratings currently. But also, I think that it is, while it would be great if institutional investors were more discerning, I would say, of taking on just not following this kind of investment grade AA+ kind of cap or floor, however you want to look at it. I also think it's unlikely that will happen now. The volatility in the market is actually going to make everyone more conservative rather than less. And the only there will be some risk-friendly capital, whether it comes from some of these development finance pools, or even sovereign development pools, etc. But how, again, it's the same. How long do you need to stretch it for is unclear at the moment. And but it is very clear that you need to use it to get as much leverage as you possibly can of private capital, right? Because I think that across the board, we've all agreed on that. But sometimes we don't necessarily know the way. And because we're in this kind of Harold said TCX went into this period prepared. And I think that makes them different from everybody else, because this kind of crept up on us. We were not prepared. And as a result of that, we're going to use old tools to solve a new problem. And so they're going to do de-risking exactly the way that we've done it for 20 years now, with maybe sort of, incremental gains that we've collected along the way. And I think that is not the most leverage that you can get out of that capital. And I mean, I know that JP, Harold, and I have some ideas of better de-risking, but I'll let JP maybe talk about that.
Thank you, Kanika. Now, actually, yes. In a sense, I agree with all of you, and I think it's a matter of execution. In a sense, yes, I agree with Harry. It would be great if the institutional investors extend their risk appetite. But I agree with Kanika to the fact that they will extend their risk appetite. Actually, their appetite is blocked for the moment by a perceived risk, not by the real risk. And the point, and then I agree with Frank, which is on the idea that yes, kind of monoline is not something which will make the capital flow at the necessary scale, but it is the necessarily artifact that you need to put in place in order to come from a perceived risk to an actual risk analysis. And at the beginning, the institutional investors will not be able to invest time and effort and money to do the job. Maybe with the pressure of the situation, they will do this work to better understand what the actual risks are. But it's also, I think, the role of the institutions and the countries, the developed countries, to help them to make this job by making their life a little easier with the monoline type of instruments of de-risking, the time necessary that they realize that the actual risk is not as high as they perceive, so that after that, they either don't need at all any de-risking instruments, or leverage that you can make with the public money through these instruments is much higher. And for the moment, the calculation we've made was around 15 times. But you can also imagine with a better understanding, a better data collection as well of the risk in the new context, you can probably get to much higher leverages on public money, and that's where it would be helpful. So it's more a transition work an execution issue than in principle what to do on the long term.
Yeah, may I jump in just real quick? Just on regarding the policy will that Harry was mentioning. I think this is such a crucial point here, because we can see today such a huge capacity of change from society. From, overnight, everybody was in quarantine. And it was such a fast movement from society. And I think we could really show our capabilities of adapting the way we are living in today. So if we can make a quick comparison to other crises like climate change, for example, there is clearly lack of political will to tackle climate change if we compare to coronavirus. And why are we talking about clean tech here? Why are we talking about renewables? If we take it to of course, it's not just about climate change, but carbon emission is a huge contributor for us to be talking about energy transition and wind power and solar power and smart grids and smart cities. It is something that we do consider when we talk about our renewables or energy sector. And on this matter, we do see some institutional investors divesting from coal, plenty of them. And but sometimes they just don't invest in renewables. They prefer retail, just for a de-risk matter, because profitability might be the same, but the risk there's much less risk than power sector. But power is such a fundamental asset. We all depend on power today, so much, so hard, that we definitely see that we need some investors to step in and take this responsibility, and not just on their corporate strategy. We do need, and sometimes this kind of responsibility is taken by the government. So we really need to understand a way to motivate our institutional investors to step in and really look at this matter with some responsibility also towards society, and not just on their own businesses. So I think there are the political will, there is how we tackle the crisis that we live in, and what are the responsibilities from the institutional investors. Because here in Latin America, for example, if we can compare to Europe or to North America, for example, we're such an immature market, and that reflects the political will, the local, the regional political will, because there are no regulations that demand responsible investments, sustainable investments. It's completely open. It's different from Europe, that we see ESG becoming something that is regulatory mandatory, So yeah, this is just a few points I would like to comment.
I think what's interesting, because we're talking now a lot about institutional investors and why they're there and why they're not there. I think if we look at Europe, we have during the past years, almost past 10 years, we had a significant increase in institutional investor activities in renewables and clean tech, which generally means that sector is something which is interesting for them. So because they're doing a lot there. We have a lot of projects also being sold and being bought and being institutional investor backed. So be it on the equity and also increasing on the debt side. So the sector seems to be something that's interesting. So there must be something else why the money is not flowing into emerging markets. And I think we already touched upon it, which is the emerging market risk, the country risk, the forex risk, etc. And Yogo, you make one important point, of course, that institutional investors focus on unless they are dedicated funds only targeting one sector like renewables, they're looking at risk and return, and you compete for their money, whether you are now power, or whether you're transport, or whether you're retail, or whether you're real estate, right? They invest where they see the best risk return relation, and of course also they have to think about their portfolio. I'm actually wondering whether we have Harry back. I can see him still in the call, but I'm not sure we can hear him. Harry, are you back? Because we lost you in between. No, it doesn't look like he's on mute, so may not.
I'm here.
Okay, Frank.
Hey, we can hear you again. Yeah.
I have 3 children trying to have Zoom lessons, so I think at some point the UK infrastructure cracks under the strain.
Well, welcome to the club. We have the same issue here. At least you seem to have enough video conferencing facilities in your house to accommodate.
Well, I'm not so sure. And the other, of course, is that being teenagers, they're much more adept at getting priority over the Zoom than I am.
So you were interrupted when you were disagreeing with me.
Sorry, and I caught some of the subsequent comments. I mean, I think my point was to say that I think it's also important to encourage institutional capital to broaden its appetite, and both because I think they will find a fair risk return profile in developing markets, but also because if they don't, then you're still avoiding the big problem. You're just finding some other the new monoline, wherever that mythical creature may be, to take the credit risk. And in fact, I wanted to say that just before the crisis happened, and still we're working on this, we're having surprising amount of success in building interest in institutional investors for some of the bigger markets that we're operating in. And the critical thing has actually been the critical mass of investments. I think what was really holding back people is we would come to them and we'd say, listen, do you have an interest in taking, some exposure to a 50 megawatt or 100 megawatts in, let's say Jordan? And to be honest, the answer was not, no, we'll never touch Jordan. It was, there's no point us, you know, spending all our time understanding the risk and explaining it to our investment committee for a 20 million stake. You know, here we are trying to push out, you know, billions and billions. The 20 million just doesn't move a dial for us. Now that you're seeing markets, you know, in Egypt is a good example where you have, you know, gigawatts of renewable capacity. You know, people are willing to really look at it, and then you show them the returns, and that starts to look quite interesting, especially when, you know, what is it? If you want to lend to Germany, you pay for the privilege. So we were getting some real progress and getting some traction. Now, obviously, that's all on hold right now, but things, you know, I'm optimistic, and it reflected what I was saying, that if you work with institutional investors and if you can show them some scale, then you can get appetite.
Frank, if I can add to that. So I very much agree with what I just said. I think investors are not altruists. They have fiduciary obligations, and they need to invest where they have returns. And they are not going to do it for 10, 20, $30 million tickets when they are managing, I don't know, $1 billion or 2 or 3 or 5. Or more. So you need to come back with what I started with, which is it has to be an asset class and there has to be a scale. But there are 3 other things that that we all collectively need to put together. And Frank, I think you talked about it when I joined an hour ago, which was the first thing, well-prepared projects. We are seeing dearth of well-prepared projects, especially in the jurisdictions where they are most needed, which is in Africa. And when we see a good project, there is a lot of funding available for a well-structured deal. So that shows us that collectively, as various players in the space, we need to find a way to support well-structured projects. That's point 1. Point number 2 is a policy environment. You know, we can bring all the investors in the world who have green targets, ESG targets, even emerging markets targets. You know, 6-7% of the endowment goes to emerging markets. If you don't have the right policy environment, if your utility off-taker is bankrupt, there is nothing you can do. You need to put in structural change so that the utility is a good off-taker and you can have energy storage on a grid and a few other things that you need to have in place. And last but not least, how do we actually get investors to come in? You know, I always keep telling my friends who work for various pension funds and other funds that I'm not going to take them to, say, Togo or Burkina Faso in the first place. I'm probably going to take them to Jordan and Egypt first, because risks there are such that, you know, there's enough projects that have been done. There's enough de-risking that has been done, and they're probably more comfortable going to those markets rather than going to the frontier of a frontier. So start somewhere where you can get these pension funds and other investors reasonably comfortable with the enabling environment around it. So those are the 3 things that I think would help us move the needle on investors coming in. Thank you, Frank.
Well, thank you, Albert. That's very interesting. Of course, I mean, as I said before, I live in the region here, I live in the Middle East, and there is plenty of space to do really, really big projects, which, of course, if we look at some other countries, it's going to be much more challenging to do project at the scale of 100, 200 megawatts without running into other issues, which could be environmental, etc. And so I think we're facing, I fully agree with what you say, but I think we're also facing a certain challenge in certain countries to come up with very large scale projects, which are going to attract institutional investors. Is it, but you mentioned also, I wanted to come back to the point of well-structured projects, because what is the question to all of you? I mean, what's your perception right now? Is it, and when we look at what a lot of people always call the infrastructure gap, or call it here a bit of gap of financing for renewable energy, do we have a gap? Do we actually not have enough financing available for all the projects? Or is that gap also created to some extent, or to a large extent, by the fact that there are not enough investable or bankable or well-structured projects, and there are too many projects out there which are not well-structured? And the question is why? Why are they not well-structured? Is it Is there just not enough money flowing into early stage structuring advice and feasibility studies, etc.? Or is the majority actually well structured? What's your view? Because that maybe is one area where we can also tackle and help governments to come up with more projects. Jean-Pascal.
If I may, I will take my cap as the project developer, which was my previous job. I think that developers across the globe now, especially in renewable is not rocket science for sure. So we know how to develop projects, but we have to deal with the environment in which we are developing the project. And here it's coming back exactly to what Elzbieta was saying. First, if the regulatory framework and I would say the enabling environment in general is not sound and clear, and I'm not even mentioning the corruption issue, then it will be almost impossible for developers to develop properly, even if they are the most experienced ones. The second thing is exactly the question of scale that was also mentioned. If it is to make a 20 megawatts somewhere, you will and we will never spend the money and the time necessary to understand a completely loose environment and regulatory framework, and we will just drop the market because it's not possible to just spend so much time and so much money and so much efforts for a small market and uncertainty. And that's the reason why not only, especially you were mentioning Togo and Burkina Faso, but especially for smaller countries, it is important for them to start to consider the fact that they would have a big interest in working together to procure themselves for this infrastructure and develop common regulatory frameworks, common procurement schemes, so that they become a big enough market for developers and stable enough market or understandable enough market for developers to do their job and invest the time and efforts which are necessary to well prepare the projects. Again, and that is to a certain extent, this is not specific to developing countries. I started my developers work in France at a time where everything was uncertain, and we had to imagine everything about France. And to a certain extent, France was a political risk. And France changed 17 times the regulation in less than 10 years. So there is no, I would say, developing or we are all developing countries in that sense. But the lessons learned by the first movers in this is precisely that you need to have a sizable market, sufficiently sizable market, and you need to have a stable regulatory framework. Without that, it will be very, very, very difficult to have a real pipeline of projects which can build a class as Elzbieta and many others are looking for.
Frank, may I also come in to follow up on what Elzbieta said and now Jean-Pascal? I think one, in order to achieve the sizes, the minimum sizes needed for institutional investors, you need aggregation vehicles. And that's where the MDB community, the DFI community is particularly challenged to do that. I also think you need to have what Jean-Pascal just said, this harmonization and standardization of contracts so that these aggregation vehicles can purchase cash flows from different countries. And then when you add to that this idea that you will have the PPAs more in the local currency, then you need, of course, to work with risk markets to homogenize the cash flows into one, or in a few currencies. And here we have seen also some experience in the past 2 years at TCX. We have worked with IFC, EBRD, and FMO more recently to separate. So loans are flowing into developing countries indexed to local currencies. By separating the credit risk and the currency risk, you increase the appetite of institutional investors, because some institutional investors feel very comfortable taking certain technologies risk, certain sectors, they know it. Some institutional investors have interest in a currency risk as long as it has no credit risk attached, or from AAA issuers like EBRD, IFC, and FMO. This is still, we have sold about, together with our partners, which I mentioned, about a billion of that. That's still very small, but it just highlights that if you differentiate the risks, and if you aggregate, standardize, and differentiate, you can probably scale up and achieve that asset class. And there are people who are interested in solar bonds, right? Only solar bonds if it's de-risked. Going back to what I said before also, that sometimes the return expectations of the institutional investors are exaggerated. I mean, we know that many pension funds are completely underfunded, right? And they are forced to have very high return expectations. And if you have effective de-risking, it means that the dollar return goes down, and very often this dollar return, this new de-risked dollar return, is below the thresholds of institutional investors, which were set with a certain risk in mind, which is not there anymore. I don't know, Alsbeta or Harry, what your reaction is with your institutional investors when you talk. I mean, we certainly experienced that at TCX. So I would be interested to hear the comments.
Just one question, Harold. Talking about these institutional investors and their pricing or return expectations, are we talking about equity investors, or are we talking about debt providers?
We only talk about debt.
Okay, interesting.
But just to sort of, without disagreeing with anyone, I think a question that I have across the board for all the other panelists is, which part of this is new? How is this COVID influenced in any way? I mean, we were talking about standardization, warehousing, underwriting specific risks, doing pooling of risks. I'm just trying to understand, is there something that our conventional wisdom doesn't tell us that this is an opportunity for us to sort of try at least? Because I see how all of this is maybe more important now, but I just don't see why we would succeed at it now when we haven't succeeded so far.
Kanika, Douglas here. One of the key things about the Paris Agreement...
Douglas, it's very difficult to hear you. I'm not sure whether you're far away from the mic.
Can you hear me now?
It's a bit better, yeah.
Is that better? Sorry. Yeah, Kanika, one of the key points from the financing mechanism of the Paris Agreement is sustainable development mechanism. That means that ensuring that indigenous local people benefit from projects. So there is a clear opportunity here to align CleanTech, Green Deal type projects with benefits to disadvantaged local people who are the most vulnerable to the pandemic. Yeah, we're a bit short of time, but I'm quite happy to share through Thomas the work we've been doing for a number of years on cooperative approaches, sustainable development, and international offset trading. Yeah, thank you.
Thank you, Douglas. I mean, from my side, one response to you, Kanika. What I found very interesting is if you look at the project M&A pipeline in renewables and CleanTech, that was extremely strong during the first quarter of this year, exceptionally strong, which seems, if we talk about opportunities, which actually seems that the appetite of a lot of investors in renewables has not gone down. So it's to a certain extent, it seems to be a sector that is actually less affected. by the crisis than others. And I think that's a real opportunity. And but they also fully agree with what Harry said. We need to make sure that the models which are in place now show and demonstrate that they're stable, because if we now have PPAs which are going into default and projects which are going into default, then this trust in the sector which is there will be lost, and that would be catastrophical most likely, because then the money that is already there would flow out. Although, of course, what I'm just saying is more true for Europe and OECD markets, because that's where we see most of the M&A activity. Some of it in emerging markets, but I think emerging markets on top, they're facing an additional challenge which may increase, because if the emerging market credits are going to worsen because of the crisis, then we have an increasing challenge actually to bring money into these markets, which is an opportunity again for DFIs. It's I remember in the financial crisis, at the height of the financial crisis, when I was a banker and had to finance project, it was actually easier for me to finance an emerging market project through DFIs, which were still liquid, than to go and try to finance a project in Europe to commercial banks, which all had no money and didn't want to do anything at the time. So maybe we're going a bit back to these times, which is an opportunity as well.
Frank, I'll just add to it, and then I'll have to peel off because I have another commitment in about 5 minutes. Just wanted to say a couple of things about two things that we need to differentiate, I think. Money going into sustainable infrastructure and money going to emerging markets, or money going to CleanTech and money going to emerging markets. When it comes to investors, most of them have allocations, especially pension funds, most of them have allocations for emerging markets, and that's 5, 6, 7% of the book, whatever they may decide to do. And then we've got this incredible commitment by many pension funds, by many asset owners to do more green, to do more ESG. I was hosting an event as part of our spring meetings just a couple of days ago, and we had a few bankers on a panel, and they talked about, quote unquote, insatiable appetite for green investments among their asset owners that they work with. So there is a demand for well-structured sustainable investments. There is a demand for clean tech in the books of investors. But the two don't overlap. The emerging market demand and the green demand do not overlap. And this is the issue that we have to solve as a community, because it has been proven over the past 2-3 years easily that there is money to be made in renewables, there is money to be made in sustainable infrastructure, in clean tech, in many others. It hasn't translated into the emerging markets. And I think that's the critical point. So I see the appetite for green every single day. And I'm seeing, unfortunately, due to COVID, a diminishing appetite for emerging markets. And we as a community of practitioners need to find a space between the two, which is a de-risking. And that's where the new future will be, because that's what we have to do. So I just wanted to say these couple of words, and I have to leave you in about 2 or 3 minutes. So I'll listen in, and then I will peel off. And Jean-Pascal, thank you so much for connecting us on this virtual session.
Elizabeth, it's a pleasure. Thank you very much for taking the time for being with us and waking up so early for us. I really do appreciate that. Thank you very much.
Thank you. And my question goes a bit to Thomas, because we are about 20 minutes over time. So I'm not sure what the schedule said.
But you understood, Frank, our vision, yes, and also that we need to work hand by hand with financial community. So you have at least 1 hour, you know. Just please think how to provide those trillions, yes. So yeah, you have as much time as needed.
Yeah, I don't know.
In your hands and also of Jean-Pascal.
Okay, so I don't know how the rest is doing. I mean, how much more time you have. We can also wrap it up if you want, because I think we have some repeating arguments. Let me summarize so far what I think is the outcome of the session, and then you tell me whether I'm missing something. I think clearly what I took away from our discussion is a few points, right? So how do we get the financing bottleneck solved? How do we get more money into emerging markets? How do we actually tackle this whole crisis? I mean, one thing that came clearly up is and that's not new, that's not due to the crisis. We need We need scale. We need this to be an asset class, and we may need to aggregate certain projects. And for this, we need standardization, harmonization. It needs to have scale. I mean, that is one point. Otherwise, we're not going to be able to bring institutional investors to the table, right? The regulatory framework needs to be there. It needs to be clear, sound, proven. That's also clear. We will need, and we hopefully will also see more local currency financed and projects, and also, which means more local currency PPAs. Just to take up the last point that Alberta was making, there seems to be a huge discrepancy on the money side between the appetite for emerging markets and the appetite for renewable energy and clean tech. And so we need to use the momentum that is there, and the appetite that's there for renewables and clean tech, which seems to be really high, and bring this more into emerging market. And we talked about de-risking and other things that need to be done to do this. That's how I would summarize the discussion so far. I know we talked about a lot more, but I also don't want to give you a summary of half an hour. So I see no further comments. Should we wrap it up?
Yes, please. Yes, please, Frank. Thank you very much for this great moderation. I think it was really helpful. I fully concur, and to a certain extent, answering Kanika's question is yes. There's actually absolutely nothing new in all what we said. It's something which is perfectly understood and well known. I think the difference is now that the COVID crisis is at the same time a huge challenge because the public money is going to be even scarcer than it was. But it's a huge opportunity because we are at a point where we understand the emergency of doing something and what all the creativity that we had before. And again, Kanika and Harold, we have published a very good document 3 years ago at COP22, three maybe, three, on the de-risking. It was a little bit considered like too complex, too advanced, too not really necessary. But now that the situation has changed, probably the same kind of ideas improved by the experience that we already have has a change, as a chance to come up. And I think that's something that we should be working all together on in order to scale it up now. And it's precisely also why I created this new organization called Scale, because it's precisely what we need and what we are all after. So, to again, thank you so much to everyone for accepting to participate to this roundtable. Thank you for Thomas and the CleanTech Business Club for the amazing work in putting all this together in such a short moment, such a short time. I think it's a first. It probably will not be the last, and certainly not be the last. Let's meet very soon to build up on this conversation and make it happen for real this time.
Can I add, Pascal, Jean-Pascal, because I believe that it's so important to create this close relationship between financial and clean tech community on the leadership level. So we have this chapter in our club. So Diogo is one of the leaders. We have also Klaas Helmke, who is one of the leaders in this chapter. And Tony Siba is, let's say, our visionary leader in this chapter. And I would like to ask you eventually to also cooperate with us closer. Yes, we will not spam you with all the messages, but I would like to discuss afterwards with Frank, yes, because we already discussed with Cornelius. So maybe we can organize together some group of leaders to, you see, with this chapter, and then we can let's say, not just speak, but let's make some actions, yes, together on the leadership level. And I really would like to thank you because as you saw in this video from Dubai, we always wanted to unite visionary leaders from financial community. And I didn't expect that it will happen in a such short period, yes? And this is thanks to Frank, thanks to Jean-Pascal, thanks to Cornelius, and thanks to all of you. So thank you so much.
Thank you.
And let's scale up from billions to trillions. Thank you.
Absolutely.
Thank you.
Thank you.
Bye-bye. Take care.